Now, if you look at data of over the last 10 or 15 years, and 10, 15 years, as you would be well aware, we have seen multiple cycles, right? Demon happened, COVID has happened, bull runs have happened, balance sheet crisis have happened. So over a 10, 15-year period, we have seen multiple phases. But life insurance, as how much of household financial savings is getting channelized into life insurance, it's been 17%, 18% consistently. So almost over this entire 15-year time frame, right from around 2010 to like 2024, if you were to plot that of every 100 rupees of household savings, which gets channelized into various financial products, how much comes into life insurance? It's 17, 18 rupees consistently. What it means is of every 6 rupees, practically 1 rupee is coming into life insurance.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, and on today's episode, I'm thrilled, really thrilled to feature for the very first time on our show ICICI Prudential Life Insurance. My guest today, Srinivas Balasubramanian, Head of Products and Marketing at iPru Life. It's probably referred to as Shrini. By his friend Shrini, I hope I can call you that.
Yes, you can very much, Anupam. Thank you so much for having me over here.
Welcome, and I'm really thrilled to have you here. We don't do life insurance as much as we should. So someone as big as iPru Life, I think, let's just get started.
Absolutely. Let's rock and roll.
Financial planning. Okay, last 4-5 years, of course, it's, there's been more awareness about it. People have more tools to figure their stuff out. Life insurance, though, is a kind of conversation that gets pushed slightly back. I have no idea why. Okay, I would assume that should be the starting point of all conversations as a bare minimum product that you start with. But I want to get your perspective, as someone who's been in the industry for 20 plus years.
Yep, 2021.
And it's a conversation that you would be having with your friends, your family, places that you go, people that you speak with. Let's start with a why. As in, why does that happen? Why is life insurance in India still not as widely spoken about as it should be?
Great. I think it's a super good question to start the whole conversation with. Like you said, I've been with ICICI Prudential Life Insurance for the last 21 years. And it's great to see not just how insurance as a category has evolved, but also the overall financial services category and the various options which customers have now versus what it was like about 20 years back. But just to put a bit of numbers into perspectives, like you rightly said, life insurance is not maybe spoken about much, but the reality is that customers do buy life insurance policies, and they do buy it in fairly good numbers. Why do I say that? Now, if you look at data of over the last 10 or 15 years, and 10, 15 years, as you would be well aware, we have seen multiple cycles, right? Demon happened, COVID has happened, bull runs have happened, balance sheet crisis have happened. So over a 10, 15-year period, we have seen multiple phases. But life insurance, as how much of household financial savings is getting channelized into life insurance, it's been 17%, 18% consistently. So almost over this entire 15-year time frame, right from around 2010 to like 2024, if you were to plot that of every 100 rupees of household savings, which gets channelized into various financial products, how much comes into life insurance? It's 17, 18 rupees consistently. What it means is of every 6 rupees, practically 1 rupee is coming into life insurance. Now, while that is a longer term time frame, even the last couple of years, the overall industry has seen a pretty decent growth. For example, this year, FY25 that I'm talking about, 9M growth for the overall industry has been about 15-16%. Within that, private industry has grown a little faster than around 20%. Larger private insurance companies like ICICI Prudential Life have grown faster than that. So longer term trends, consistent share of household financial savings coming into insurance. Near term trends are fairly bullish. So coming back to your point, people might not be talking much about it, but as long as they are buying enough life insurance, we are cool. So that's fine.
Penetration wise, I mean, I don't know what metric you track, whether it's premiums as percentage of GDP or any other number that you track. How is that?
See, again, various ways of looking at it. I would say the best way of looking at it is overall, how is the GDP growing? Within GDP, how much is coming into financial savings? Within that, how much is coming into life insurance? And within that, as individual players, are we able to attract more of that? So that story, like I said, has been a fairly good story and pretty positive. Interestingly, when we talk about life insurance, we tend to think of it as one homogeneous entity, right? So all the numbers that I spoke of earlier were all about life insurance as one industry. But it becomes very interesting the moment you try and decode that even within this homogeneous entity called insurance, there are distinct product categories. And what's really exciting for anyone in the industry is that how specific product categories are seeing specific consumer trends, consumer needs. And it's a great time for the industry on how are you able to respond to these needs and trends. For example, what do I mean by homogeneous entity versus specific product categories? Actually, there are three distinct product segments within the whole umbrella of life insurance, right? And I would like to spend just a minute talking about these
Please.
three different
Yeah,
segments.
of course.
The first segment is protection, right? Term insurance and so on and so forth. Which one way of looking at it is it covers the risk of dying too early, right? At the other end of the spectrum, you have retirement planning products, which conversely cover the risk of living too long.
Yeah.
And then you have the middle bucket, which is of long term savings. So, insurance is equal to sigma of protection, retirement planning, long term savings. And within each, some pretty interesting trends, consumer segments emerging. Like I said, it's a very exciting time for the category to be catering to these needs.
We'll get into all three of them. India has had a pretty long stay with a large public sector insurance, LIC, which has been there for ages prior to my generation as well. Money back policies. Okay, so the entire concept that if I'm paying something to someone, I expect a return at some point of time. Okay?
Right.
And that need or that desire or that goal was satisfied really well at some point of time in the past. Is that still true? Like, if I were to, the three products that you mentioned, for example, are money back still as hot, as big?
Great. I think let's sort of declutter this whole lexicon, right? So, a money back can have different connotations. So, we'll just take a minute to explain. So, I spoke about those three distinct segments. So, in protection policies, there are broadly two categories of insurance. One is it's like an umbrella, right? You bought the policy. In case if the customer passes away, the insurance company pays the cover amount to the family. In case nothing happens to the policyholder, fine, great, you live, right? Congratulations. But still, as an insurer, I don't pay back the premiums that you pay. A small variant of that is what are known as return of premium policies, right? Where, of course, I charge a slightly higher amount of premium. In case a person passes away, unfortunately, the insurance company pays the cover amount to the family. In case a person survives the full term, good news, right? Then I pay all the premiums back, summation of all the premiums back to the customer. These are called return of premium policies.
Sure.
Typically, return of premium policies constitute about 15 to 20% of the term insurance market.
Oh, okay.
But I would say it's sort of waning a little bit. It's a slow process. But more and more customers are preferring the pure term insurance where something happens to me, pay the cover. Nothing happens to me, I'm cool. Don't have to pay anything back.
So you're saying that within that category, 80% is still what we call pure risk or
pure term
and
policies.
15-20% is
That's right.
money back in some way or the other.
That's right.
Okay.
Now coming to the middle bucket of savings policies. There again the term money back can be a little confusing. So again we can just say that in the savings kind of products there are two types. One is where you get a one single time lump sum benefit at the end of the policy term. And then there could be policies which keep giving periodic payouts to the customer. Normally, the term money back was used to refer to the second type of plans,
okay.
where there would be some periodic bullet payouts to the customer, along with something being paid at the end of the policy. That kind of benefit structure continues to be, because that is essentially a matching of cash flows.
Yes.
So depending on where you are, depending on what are the kind of goals you're planning for, if you need periodic payouts, that category of product continues to be there. So for different companies, that proportion would be anywhere between 25 to 40% of their mix. So the word money back needs a little bit of delayering. So within this, I guess that answers the question.
At a broader level, people are now more open than before to taking a pure risk cover. Saying
Absolutely.
That, forget it, I don't care whether the money comes back or not. I just want that for 25 years of my working life or 35 years, whatever the period is, I'm covered. That's it. If anything happens to me, then at least my family should be covered.
Yes.
That I think is a good development.
It is. I mean, this whole thing about that return of premium, again, look, it's a customer choice. I'm not going to, diss a customer's preference. But I guess the most optimum thing to do would be to, pay the optimum premium, get a cover. It's like, again, going back to that umbrella analogy. You're not going to tell an umbrella maker that, look, it didn't rain, so here's your umbrella, give me my money back, right? I mean, that's it doesn't work in that context. So, yeah.
Folks, we're going to get to the other categories also soon. They on their own also, they're pretty interesting. Okay, Srini, what's been happening in the budget? Like in the last, I would say, 2 or 3 years, I haven't seen so much activity on insurance premiums and policies, and I have in the previous, say, I don't know, almost 10, 15 years.
Yeah,
But
seriously.
here, every year, something or the other is happening, and you just demystify that for our audience, and if that's had any impact on flows or any trends in
Right,
general.
right. Yeah, so yeah, Anupam, I mean, the budget has suddenly become like the most important event in the life of the industry. But thankfully, it's all sort of over the last 2 or 3 years, different changes coming in. I guess we can say hopefully dust has settled and there's some clarity that has emerged. So a lot of these changes, taxation changes, were in the zone of the unit link policy category, right? So as things stand, here is what is a clarity that I can share with the listeners here, right? For any person paying a premium of up to 2.5 lakhs in a unit link policy, the proceeds are completely tax free.
What you get in the end, you're saying?
Yeah, what I get at the end is completely tax free.
Yeah.
Okay. So just to put those numbers into context, almost 95% of my policy, the ULIP policies, come in the bucket of less than or equal to 2.5 lakhs per annum. Beyond that, right? If the cover multiple that the person has opted for is 10 times or above of the annual premium, then the maturity proceed, what I get at the end, is taxed as per LTCG, okay, of 12.5%, which is consistent with almost all the other products that are out there. The beauty here is, while there is an LTCG component, a unit-linked product gives the customer an array of fund options across different asset classes. So regardless of whether the person has invested in an equity or a debt or a balanced fund, across all, it is 12.5%.
Okay.
So finally, after like about 2 or 3 years of different announcements, interpretations, there's a clarity. So if you're paying a premium of up to 2.5, including 2.5 lakhs, it's completely sorted. It is tax free. Yeah. Beyond 2.5 lakhs, it is as per LTCG. But of course, you have the exposure too.
I find it interesting that you say that irrespective of the ULIP where it's investing, could be pure debt, could be pure equity, could be balance, could be whatever it is. And ULIPs have a massive choice for people who want to invest in them.
That's right.
Its LTCG is 12.5.
That's right.
Whereas if I were to go for a pure debt fund,
right,
then that taxation would be that taxation.
Absolutely. So that's I would say in a way the ULIP clarity and the simplicity now for both consumers as well as for our sellers. That across, regardless of what asset class it is, 12.5%.
Up to 95%, it is still exempt, which
it
is the payment and what's called EE and stuff like that.
Exactly.
And 95% is a fairly large number. So that's a good thing. And a small technicality. This is for premiums bought after. I mean, for policies, not premiums. Sorry, it's for ULIPs bought after a certain date. Like I have a ULIP going. I don't know, maybe I bought it somewhere in 2008.
So you're cool. You're fine.
Nothing this is after a certain date.
After a certain date, yes.
There's no retrograde stuff happening.
No. Thankfully, yeah.
Anything else there? I mean, in budgetary changes in the last couple of years, this was a big one.
Yeah, this was a big one. So this itself. So for example, the whole LTCG thing came in 2021. So there have been different layers of clarification being provided.
Right.
So in fact, even this last budget announcement, there was a clarity. But what I shared with you now is after those 2 or 3 years of different things being said, this is as it can be laid out for everyone.
So this is a good time for me to just recap to our audience what are the various, tax, the income tax, which is levied on various insurance products. Okay, so right up straight upfront, a pure risk cover is tax free.
Yes,
it's
that's
in the form of a capital receipt.
That's right.
So folks, that's the very first one. If you have pure risk cover, when the payment comes out, that is tax free because it is in the nature of a capital receipt. You're not, it's not an investment product. Okay. Number 2, for a ULIP, up to 2.5 lakhs, like Shini said, and above 2.5 lakhs. So please be careful with that. What about the other products? What's the taxation scene there?
So that leaves us with the savings products of which are non-linked variety, right? So here, once again, in fact, here up to 5 lakhs, the proceeds are completely tax-free.
5 lakhs being the lump sum or it's a premium that I'm paying.
The premium that you're paying. The premium that you're paying, right? And for ICICI Pru Life, that would be like much. I say 95% for ULIPs is up to 2.5 lakhs, right? In non-linked policies, it's higher than that. It's almost the same zone.
Right.
So those policies where the annual premium being paid by the customer is up to 5 lakhs, the maturity benefits are completely tax-free.
Okay.
Right?
Yeah.
Now, if the premium exceeds 5 lakhs, then whatever benefit the customer is receiving, right? From that, I deduct the premiums paid. So, for example, the person has paid 5 lakhs for, let's say, 15 years. Yeah. So, he has paid 75 lakhs. Yeah. And let's say the end benefit is 1.2 crores.
Sure.
So, the balance, which is around 45 lakhs, will be taxed as per income at that point in time. So, typically, for example, if a person takes a 15 or a 20-year policy term, because that's typically the average term of a savings policy. So, in this example that I gave, the person 75 lakhs is going to be completely tax free because that is the premium that you have paid. The remaining 45 lakhs in the example that I gave will be taxed 20 years from now as per the prevailing tax slab at that point
At
of
that
time.
point of time. I think that's pretty good. I mean, I think that it's basically trying to close that door on a lot of high premium policies that was the norm at one point. I mean, obviously for 95%, this literally changes nothing. But it's
Exactly.
only for the HNIs who probably saw that insurance product in whichever way or form. It could be a savings plan, it could be a ULIP, as a way of putting in some money, and
Like an asset diversification tool.
Shini, how do how do you sell insurance to Gen Z, right? For a generation that believes in living the experience. You only live once. Why should I even buy insurance? Yeah? I'm like,
Anupam, we have this. I have like deep respect for the Gen Z slash the younger millennial cohort, because at times we as as observers, we tend to put on these neat labels. Oh, this is a YOLO segment, or this is the FOMO segment, or this is the experience segment, live in the moment segment. But surprisingly, the kind of engagement that I'm seeing in this segment for insurance as a category is quite cool. It's quite interesting, right?
okay.
Why am I saying this? If I simply look at the growth that I am witnessing as a brand in the 25 to 35 segment, people in your age group, for example, it's actually much faster than the overall growth of the company. They're actually the growth engines, in a manner of speaking, right?
Okay. I didn't expect that.
Yes, right?
Okay.
And then you talk to them and you're like, I mean, I don't say why you buy insurance. Obviously, I wouldn't say why you. I'm like, okay, when I made this product, I was thinking of someone who's maybe in their mid-30s. You bought this product, so what did you see in it? And then they come back with these amazing use cases. So let me give this example. So a couple of months back, we launched a ULIP. I'll talk to you about it in a bit. Which we thought was ideal for people with young children, right? We said, okay, just married couple or maybe a couple of 1 or 2 year old kids, they invest in this product. Was meant for that. At least that's the way we thought of it when we designed this product. And then we are seeing some early trends. We are seeing a surprising number of youngsters, 28, 29-year-olds buying this product.
Okay.
So we spoke to a couple of them, saying, okay, great, nice choice, but tell us why you bought this product. And you know what's the story which is emerging? These all youngsters from smaller towns. For example, this person I spoke to, she is from Jabalpur.
Okay.
She's now working in Bombay. And so I said, okay, so you bought this product. What did you see in it? She said, look, my parents, my father's going to retire in a couple of years' time. They're going to be financially dependent on me.
Sure.
For some point of time at least. So I'm buying this policy so that the payout which I'm going to get periodically, which was a product design, will actually become in a way their pension income.
Oh, nice.
So exactly, right? So when you talk to them, they are figuring out all these interesting use cases of the product in their lives. It's almost like writing open source software. So you wrote a certain software and you then put it out to the user. And I'm finding that this the Gen Zs and the millennials. And I'm telling you, we at times tend to use these labels and say, they are not going to look at insurance at all. But it's amazing. Like I said, end of the day, proof of the pudding is in the numbers. And the growth that we're seeing in this segment is faster than the rest of the segments.
I mean, it's what a wonderful point, right, folks? If you have, there was a generation prior to us where most parents at that era probably worked in a state government or a central government or somewhere, where your pension was sorted. You worked there for as they do in that generation for whatever 30, 40 years, and then your pension was done. But I'm guessing that for a large section of people who did not get jobs out there is no pension,
right?
And not having a regular source of income after the age of whatever 55, 60, 65, let's say, is not something that you want to be in.
Exactly.
And if your kid can sort that out for you when they have started their job in their late 20s, that is some seriously forward planning out there.
Absolutely. And it's not just this, it's also this whole the other trends. And this segment is pretty much at the forefront of a lot of the consumer trends, like this whole thing about micro retirement. One of my colleagues, right, youngster, must be about 27, 28, he has taken an year off to pursue rifle shooting professionally. Okay. So he was back in office a week. I said, okay, hey, you're back. What happened? He said, yes, I broke into the top 20 after a year of doing this. But now I want to practice that along with work. So, and he said, I mean, it's not a lot of people are doing this, but this whole micro retirement thing, taking 1 or 2 years off, sabbatical, then this whole FIRE thing. You have written about FIRE in your book, right? So wanting to retire early. So this segment is really keeping us on our toes because so many different emerging trends, so many different use cases. How do you make products which are addressing those needs?
Thank you for the reference to my book. And it's interesting, right? Because I don't think people get the fact that when you are locking into a ULIP in your late 20s, you're kind of sorted at the same premium for the next, what, 25, 30 years, or depending on how the product is structured?
Clarification. In a ULIP, you pretty much choose the premium that you pay,
Ah.
right? So what you said, Anupam, was spot on about term insurance. By the way, because there, if you buy it early,
You're locked in.
you're locked in for the premium at which will be fairly inexpensive.
Yeah.
In ULIPs, you choose the premium,
Yeah.
and that continues to be. Of course, the younger you buy, the longer becomes the runway
That
for
was
the
my
product.
point.
That
Yeah,
is the point,
yeah.
and it's spot on.
I mean, so you choose your premium, but imagine having that and not thinking about it for the next, 20, 30 years when your income is increasing. You sorted your parents' pension. I think that should give a lot of relief to people.
Absolutely, absolutely.
Think about that, folks. We're going to take a small break, and on the other side, we're going to come back and talk more about specific insurance products and covering some areas, which are obviously hot topics as well. But don't go anywhere. We will be right back.
Did you know Indians report nearly 800 cases of online financial fraud every day, which has resulted in losses exceeding 1,000 crores in the last 5 years? To keep you safe from such fraud, I am starting my newest podcast series, Conversation with Vigilante, an initiative by HDFC Bank. In every episode, I will feature special guests who can share expert insights on the different types of fraud, their modus operandi, and how you can protect your money. Stay safe, stay vigilant, and don't forget to tune into Conversation with Vigilante. Catch the episodes on all audio streaming platforms and V for Vigilante YouTube channel.
Welcome back. Really, how has iPro Life responded to the changing needs of customers, right? Because this last 20 years, the amount of change that the Indian economy has seen, that the way of thinking of people has changed, throw in a pandemic also. I guess your need for insurance also changes there. You need it, that's one question. But the type of insurance also changes. For example, I believe that you've recently launched something called ICICI Pru Wish, which is a product specifically curated for women. Talk to us about that.
Sure, will Anupam. But before I get into Wish specifically, right? I think a larger point here is how do you keep track of different consumer segments? Actually, I'll keep referring to that a lot. And because as an insurance company, you operate in these three different spaces, within those spaces, there are multiple segments emerging, trends emerging. So creating products for these segments is what keeps us all excited and active. So I'll come to Wish once again specifically, but COVID, right? COVID made a lot of people aware about the need for term insurance to begin with, but we also started seeing a preference for term insurance with critical illness covers. So what's happening externally is also shaping consumer behavior. On the annuity side, as more and more people are moving towards the older age bracket, we keep talking of India as a young economy, as a young country. We are, but the fact of the matter is, even the 45 plus, 50 plus segment is also growing at a fairly fast clip. So as that is happening, we are seeing more and more demand for retirement planning solutions. Within the savings buckets, there is a huge connection between what's happening in the macro environment with the kind of products people are preferring. Markets are doing good. People want more of ULIPs, more of Google search trends for ULIPs, market linked returns, and so on and so forth. When markets become a little topsy-turvy, like they have in the last couple of months, the demand for guaranteed products goes up. So great as an insurance company, right? Because you're occupying so many spaces and within which you have different flavors of products, something or the other is happening all around. Coming specific to Wish, like I said, while term plans in the last 4-5 years have seen a good demand, and as a category, it's been growing for us as well as for the industry. One of the things which we figured out was there is, for Indian women, right, the predominant mindset is, let me put my needs last, and I don't know, it's an Indian woman thing or it's a women thing in general, but that's a typical mindset. Whereas on the other hand, on the risk side of things, there are certain health conditions which are specific to women.
Yep.
And a little bit of a worrying factor is some of these trends, let's say of breast cancer, uterine cancer, they're actually on the upswing, right? So we said, look, as a life insurance cover, the company, coming to the third aspect, there is a certain USP that we offer, which is that when a person buys a health insurance policy from me and the person comes to me with a diagnosis, saying I have been diagnosed with a certain condition, I have to pay the claim amount upfront, which is a bit of a distinction. I don't give a reimbursement. Ki pehle you go undergo the treatment, give me the bills and I'll reimburse the money. I'll say that, look, you've been diagnosed with the condition. Give me the diagnosis. Here is the claim amount.
Oh, okay.
So that is a big USP of what health insurance products offered by life insurers like ICICI Pru Life can offer. So we put these three things together. One, Indian women typically trying to deprioritize their needs. Two, the health risks specific to women and how those are rising trends. Three, I have a certain ability to offer a benefit which is unique. So we put these three things together. We said, look, why don't we launch a product, a health insurance product designed for women, targeting their specific health related risks with the USP of come to me on the diagnosis and I'll pay the amount upfront to you.
Yeah.
So the beauty of here, not the beauty really, or rather how the person can use this amount is that they can then choose the kind of treatment where they want to get the treatment. So do I want to get treated in where I'm working, or do I go back to the city where, let's say, I have support? Do I get it in a large hospital with better amenities, or the one which is closer home and it's easier for me to access? So you have more degrees of freedom in choosing the kind of treatment that you want to follow.
Very interesting. I'm wondering why this is landed in a life insurance product and not a health insurance product.
Great point. So like I said, the regulator has sort of carved out unique spaces and said, okay, you know what, life insurance guys, you offer this, health and non-life, you offer this. So what has come to us is the on diagnosis, a guaranteed amount being paid. We call it the fixed benefit variant. The non-life companies offer what is known as indemnity, which is the customer comes to you with the hospital bills and then you reimburse and the cashless and all of those things.
That's what the health insurance guys to figure out.
That's right.
If you're interested, folks, check out the website, or of course, as usual, as I always say, speak to your insurance advisor. Talking of the importance of advisory in insurance, I have a few insurance products. I can't make do without an advisor at all.
Right.
In general, how do you think the advisory community has supported the insurance industry? Okay, because sometimes the products are complex. Health, of course, so is, I can't understand it at all. Life is comparatively simpler. But from your perspective, where you sit at in the last 20 years, do you think the advisory community has done generally a good job?
Yeah, I would say so. See, the advisor eventually is the one who's closest to the customer, right? And the thing about life insurance is that it is a long-term contract. It is supposed to be, the typical tenure of a policy would be like upwards of 20 years. In that kind of a tenure, you need someone who has been with the customer. And I would assume that the beauty of the whole advisory model would have been that, look, I am the guy who knows when the child is born in the family. I am the person who knows that when they have sold a plot of land and there's a lump sum amount of money. So let me now advise and guide them on what needs to be done now. And then this happens. So you have these stories of the advisor who has serviced the grandparent and then the second generation and now is hand-holding the third. So I think there is a certain beauty of the intimacy of the relationship and knowing the attitude, the financial status, and therefore what needs to be done. So there are advisors of that hue, and there is deep respect because they are the ones who keep telling us what are the emerging trends while we study it all. But when they talk to customers and we get it from them, it's first-hand stories which are emerging there.
Yeah, because there is a dark side. This has been spoken about ad infinitum. It's been going on for a long time. I believe that even the finance minister spoke about it in Parliament or somewhere about the entire mis-selling thing. As someone who's a product manufacturer, I mean, the dispassionate views, it doesn't really matter to you where or how the policy or the premium comes from, but it should matter to you because there's a brand out there, and life insurance is all about brand. Like you wouldn't want, nobody in his right mind would want mis-selling. You wouldn't want any, relationship manager or anybody sitting out there to hit a quarterly target by peddling something which is obviously off the this. I'm assuming that, when the private life insurance sector had opened up in India, again, I think about 20 odd years ago, practices have at least improved. There are more safeguards out there. Would I be right in assuming that?
You are spot on. I think the category has over the last 25 years, I think it was 2000, 2001 when it got opened up, there have been a lot of checks and balances which have been put into literally every aspect of the business. So I can, of course, talk about products, the kind of products, how much are you allowed to charge, what are some of the bare minimum checks and balances which have to be put into place. Then in terms of the kind of communication which needs to be sent to the customer, what gets shown at the time of sale, what gets sent after the policy is purchased. The kind of training and certification that needs to be done for the seller. Even things like how quickly am I supposed to respond to a grievance which is being filed received from the customer. So lots of checks and balances which have been put into place. So customers can walk into this category with the confidence that, look, there are enough boundary guardrails for their experience to be safeguarded.
Yeah. Which reminds me, there's a look-in period had some changes now recently.
Free look period.
Yeah, free
Yes,
look period,
let's get the
sorry.
terminology. It's free look period.
Free
Anupam.
look period.
It's a bit of a draft thing. So as of now, a customer has anywhere between 15 to 30 days to understand the policy, look at its content, and then say, look, this is not the right policy. Please get me my money back and stuff like that. It's now being suggested that this period be extended.
Sure.
So we'll see. If it is going to be extended, it's fine. It's fine. It's just a choice being made to us.
Folks, as always, it's your money. I think that the first check and balance should be done by yourself. Okay, I mean, if you have a great advisor, of course, there's nothing like that. But you can't assume that everybody is a great advisor. So please do your due diligence before you invest in any product. Leave alone an insurance policy or a mutual fund, whatever it is. I think that there is enough and more resources out there for you to take an informed decision and protect your loved ones, by the way, because the incidence of this retired person being sold a ULIP at the age of 65 in a bank branch has been going on for quite some time, and I think that things hopefully should improve there. Okay, Shini, hairy topic. Huh?
Okay, wow, I'm looking forward.
This is like hot topic with everybody out there. I'm sure that as someone who manufactures these policies, see, I just want to get it out of the way.
Yeah,
Okay?
go on. Shoot.
Whether it's a savings plan or whether it is ULIP, the pushback always comes. Hey, these products are too expensive. You can do much better with just having a pure term plan and investing the balance in a mutual fund and all that. There's nothing new in this.
Yeah.
You probably would have heard it 5 years ago. I've been hearing it for a long time. I have still invested in insurance products. But folks, that's my experience. Do not take this as any endorsement. Your view on this, just in general, there is a market for these products. I understand that. I don't know where the gap is. And there is a market for just having pure risk and debt. I don't know whether it's either or, but your view.
Okay, this is like honestly my most favorite question
Nice.
of sorts. So again, guys, goes back to the whole thing about. So this whole question will only arise where a comparison is fair, right? So going back to the three categories we operate in, if it's a protection policy, there is nothing in it. I mean, obviously it's a unique space. Retirement planning, again, fairly straightforward. There, the insurance promises what? It says that, look, with products offered by insurance companies, we will guarantee what you're going to get for as long as you live, which is again a promise which only an insurance company can make. No one else can do that. So in a way, these two are fairly non-comparable. So let's get that out of the way. That leaves us with the middle long-term savings bucket. So I'm using the word long-term very specifically, right? Because the moment you say long-term, you're once again compartmentalizing it into a specific kind of consumer and a specific kind of a goal for which insurance is ideal. To put it into numbers, I would say if your goal is 10 years and beyond, that's when you should really be looking at insurance. If your goal horizon is lesser than that, sorry, I mean, good for you, but I don't think insurance is meant for you. Within that, the moment you talk of a goal being long-term, you need to have product which is designed to encourage long-term behavior, right? Which is where what we offer comes in as perhaps a good offering for customers, because insurance products by design, by the way they are charged or the minimum lock-in period, etc., encourage customers to stay in it for the long term. So there, again, no comparison. Because if you are really a disciplined investor who does not need the artificial construct of a product structure to make you stay on it for the long term, sure. I mean, do what you think you can do because you're a disciplined investor. But if you're the sort who is likely to be swayed by greed or fear, like we just saw, right? The market sneezed, investors got a cold. If you're going to be the sort who's going to look at your fund value every day, markets went up, what's happening? Markets went down, what's happening? You might need a product structure which prevents you from doing something operating out of greed or fear. Get the emotions out of the way. So here I'll say once again it's a choice. A bit of a digression, but have you ever been to a gym? You do, of course, right? So what happens in a gym? Every first week of January, I'm assuming, I don't know, I don't run a gym, I don't know any gym owners, but I'm assuming they must be seeing a spurt of their gym membership. New Year resolutions. And I'm assuming gyms must be like totally filled to the brim in the month of January. And as the days progress, as the weeks progress, as you come closer to the middle of the year, perhaps it's sparsely populated. The only guy who's happy in all of this is a gym owner, right? So imagine now if you had a gym which said there is going to be something which is going to ensure that you come to the gym, some kind of a penalty or some kind of a reward mechanism. Chances are a person going to that kind of a gym is going to stick to the plan and going to be a fitter version of himself or herself as time progresses. So think of insurance products in the long-term savings zone as that kind of a gym. So if you are by nature a disciplined investor, I'm not going to get swayed by greed or fear. I have my plan, I'm going to stick to it. Great, you can do that. But for a set of customers who need that external support and a product structure designed for that, that's where insurance products come into play.
What I like is this. What I really, really like is this, that the regulator and the industry, of course, has also now at a point where if you're selling a savings plan, if someone comes to you saying that I have the savings plan, you put XXX, whatever it is, number every year, and after 10 years you get guaranteed. And like Srini said, by the way, folks, only insurance companies can offer guaranteed. Okay, now guaranteed is a pretty heavy word. Mutual funds can't do that. Okay, I'm not saying that as a pro or a con, but it is what it is. That's how the language is supposed to be. Okay, now if you go to buy a savings plan, and if you're interested in one, your advisor or whoever is selling you will show you a fact sheet, will show you an Excel calculation. I'm assuming that I'm right in this.
Absolutely, yes.
Yeah, which will show you that for each and every year, how much you're paying and how much you're getting. You calculate the IRR yourself.
Absolutely.
And that is transparent and upfront to you.
And this Excel sheet is not something which the advisor can just cook up.
Yeah.
It is actually a document which is made by the regulator. The insurance company provides it, and it's shared with the customer at the time of sale. It's sent to the customer along with the document, and yeah, I guess that I would say hand on heart, there's complete transparency in how it is.
And the costs. Honestly, every policy has a cost also. So it's not like this. It's not like, see, I'm not taking a stand for a product out there, but I'm just saying that there is something called transparency now, which probably might not have existed 20 years ago, and there might have been some issues at that point of time. But today, as Srini said, I think it's more of a goal-based, behavior-based, product-based thing, and not simply comparing that a pure risk and a debt mutual fund gives me so much better. Of course it does. That's mathematics, for God's sake. It's not, you've not uncovered the truth of the universe as such. That's mathematics. And if you want that, please, by all means, go ahead for it. But the alternative, which is the savings plans, offers certain features, certain benefits. This is the IRR, these are the costs. You can go for it. I think, if you learn more, if you try to discover this and you explore this more, I think the choice becomes pretty. You will make the choice that you want to make for yourself.
Right, that's right.
I don't, any thoughts?
Spot on. I think you pretty much nailed it's in the best possible way. One of the better things I would say insurance companies are also doing here is that they're saying, look, in the saving space, is there some way apart from that whole we are for long-term argument, is there something else that we can do, which we can say that, look, this also makes it in a way unique, right? One of the trends, and it's fairly recent trend, remember I spoke about that you live and happy about that? One of the benefits that we're now talking to customers is, look, in any other investment product, you can only invest, I'm stating the obvious, till you're around.
Yeah.
Right.
Okay.
What about if I create a savings product, which apart from the conventional insurance benefit of in case something were to happen to you, I would pay the cover. Right. I also tell the customer, in case something were to happen to you, yes, I will pay the cover to your family. But you know what? Whatever were the future investments you would have made, I will make on your behalf.
Okay.
So that the goal that you had in mind, it could be, let's say, a retirement for you and your spouse or your child's education, let's say 10 years from now, that goal gets saved. So in products like these, right, not only does the insurance company pay the life cover upfront, it pays all future premiums on behalf of the customer. It gives a certain income replacement for that duration to the family, and it gives a maturity benefit that the person would have received had he been around paying all the premiums.
Okay.
So now this makes it, in a way, absolutely a unique space, because in every other savings plan, Anupam, you can only invest if you're around.
Till you're around, yeah.
Till you're around. So one is by clearly demarcating that we are meant for long-term savings, but also coming out with some of these products. We believe that there is a use case. End of the day, customer's choice, customer is the king. We make these products, we communicate clearly, and then we go with what the customers prefer.
This kind of reminds me of how back in the days, 60s, 70s and all that, whenever anybody used to be born in the family, from somewhere or the other, suddenly an uncle, chacha, mama would land up saying, insurance policy kari.
Right.
It got a bad rap, but hey, listen, it solved a purpose.
It did.
Parents parents at that time didn't have any other option. And at its core, this was a simple product. Pay every year, get every year, baat khatam. Okay, no, you don't have, at that point of time, you don't have to think of tax. You have the support of regular income. So I get that today's generation probably wants to be more in control of their finances, but I think that generation didn't have so many choices. And in an era when there weren't so many choices, this was an elegant product that worked really well.
Absolutely. At that point of time, like you said, it's about the context, right?
Yeah.
Options were fewer. And then again boils down to the intimacy, right? If you're familiar with the family, if you know what's their status, what's their goal, what are their objectives, and it served a need, right? So both the advisor's role as was the product's role. I think it was very much in line with the context and the milieu in which customers of that era were there.
Last question now on products. We're just about winding down the episode. Any retirement products? You just talk about what's been happening there. How do they work in general? I want to actually talk about retirement and annuities, but let's just start with the
Sure.
let's just start with the retirement products, because I think that's the thing about the investment products that I really like in life insurance. As I'm not a very details oriented guy. I like things that are simple, and if this offers me simplicity, then why not? So let's talk about the third segment. We've covered the first two in
Right.
a lot of detail. Retirement.
Okay, great. Retirement planning, right? We tend to think of India, again, going back to the whole demographic thing. India is a young country, etc., etc. All of that is true. Fact of the matter is, if you look at the pace at which the 45 plus, 50 plus segment is growing, it's actually outpacing the growth of the rest of the
others,
population.
yeah.
And there is, again, sorry guys, throwing a few jargons here. There's something called an age dependency ratio. So
Okay.
old age dependency ratio is the proportion of old age people divided by the working age population of a country. So around now, India's old age dependency ratio is at about 10%.
Oh,
Okay. So if for every 100 working age people, there are about 10 old people.
Okay.
Okay. This is projected to grow almost like about 25% by around 2035.
Wow.
Okay. So the proportion, I mean, as you can imagine what's happening to the younger population now is simply going to, as the curve shifts right over time, they are going to become the older people.
Yeah, I mean, you've got a demographic setting, and the two of us are going to be pretty old in the next 15 years, but our younger team out there have still some time.
Yes, absolutely right. So this whole old age dependency ratio has a bearing on the demand for retirement planning tools.
Yeah.
Okay, so that's in a way the macro force at work here. So what does retirement planning really mean? It means that in my working years, I accumulate a certain amount of money, and then I have to ensure that it gets invested in some other product which will give me a steady stream of income, ideally as long as I'm around.
Correct.
Because the last thing you would want is that my income has stopped and I'm still around, right? So this is where retirement planning tools offered by insurance companies operate. What they say is, during your income earning years, buy a product from us and we'll help you accumulate the corpus. Now, it could be a market link thing, or it could be a guaranteed benefit product.
Whatever it
Depending
is.
on your risk appetite, you can choose one of these. And at the time of your retirement, we will transfer this into a secondary product, which now I'll have to use a term called annuity product.
Annuities, yeah.
And an annuity is what will give you a fixed guaranteed income for as long as you're around, which means whether you're going to live up to the age of 80 or 90, hopefully as time passes, our lifespans will increase. So the insurance company says, look, as long as you're going to be around, this amount is guaranteed to you. So this is in the space of retirement planning and annuity. Actually, this is also, like I said, because of the demand, the growth of this segment has also been increasing. So till about 3 or 4 years back, annuity products used to be like in low single digits, 2-3% of our overall product mix.
Yeah.
But last I checked, it's almost like 11-12%.
Nice.
So
Yeah,
it's
yeah,
growing,
yeah.
and I don't need to be a soothsayer, but this segment is going to grow.
The keyword, folks, guaranteed. Please remember that. Again, I'm not endorsing anything out here, but remember that that's the basic difference between a retirement product under one sticker, under one wrapper, under one product. Okay, so please understand that also before you. Okay, annuities, I'm thrilled with the numbers that you gave me.
Yep.
Right? Because I would assume that in a young country like India, nobody really cares about annuities at all. Whereas in the US and Europe, annuities are massive. And annuities are, again, a very simple product that helps people meet a certain goal. Just talk to us how annuities work.
Okay, here's the thing, right? Breaking news: a lot of youngsters are buying annuities. You're right? Like a
All-
penny dropping moment.
misconceptions
Youngsters
are
buying
like-
annuity. I was like, what just happened? Why is this youngster buying annuity? Oh my God! It's like the young kids. Some of them NRIs. Okay, so they're like getting these software jobs. And like, I'm investing in an annuity so that the income goes to my parent bank. I'm like, wow. I mean, I'm like totally impressed with this generation already, right?
Interesting, yeah.
So annuities is having its moment, okay, and it's not just people who are on the verge of retirement or already retired. It's also people of the younger segment who are bunch of rocking things happening in that space. For example, for the longest possible time, the annuity product was you pay once, and that was meant for typically the guy who just superannuated, right?
Exactly.
So make all of your provident fund, channelize it into this annuity product. Right from the next month, you get an income.
As
So
in you get a pot of money
transfer it to this.
and you're sorted for the rest
You're
of your
sorted for life, right? So that continues to be there, of course. But now some more layers getting added to it. For example, we also started seeing a lot of people who are saying, hey, look, I'm not 60, but I'm 50 and I've made some decent amount of money and I want to start planning for my retirement at the age of 55. Okay.
Yeah, yeah.
So now you make a variant of that product which says, okay, you don't have to pay once, but pay, let's say, for 5 years or 7 years. Again, the same thing. Whatever accumulates, you can get your guaranteed income for life. Now, layers to it. People saying, ki, okay, I have me and my spouse. What if something were to happen to me? So no questions. That's okay. If you are paid, let's say 2 or 3 premiums, and unfortunately you pass away, don't worry. Whatever is the income that I would have paid to your spouse will continue to be paid.
Okay.
So that's a kind of another thing about, hey, this is good. You're giving me fixed guaranteed income for life, but what about inflation? Okay, great. Innovation, increasing annuity. So you start off with 100 rupees as hypothetically, as every year it increases by 5 rupees. It's not exactly inflation hedged, but you have at least have the comfort of your income increasing. So literally the pace at which products are being brought out here, it's and not a surprise really. Like I said, as more and more people are going to go in that age bracket, as the demand for annuities are going to increase, we will have to keep coming out with product innovations.
I ask this to almost to every life insurance company that comes here, because these are the most common questions that at least I get asked, or at least are out there from people. Number one, what is the right amount of cover that I should take?
So 3 aspects. One is, and I'll try to sort of quantify each of these. One is, what's your income, of course. 2, what is the kind of cover that you're getting from your employer, if you are getting? And 3, what is the kind of loan that you have? So these are the 3 things which should play a role. First one, your income. So I would say 10 to 20 multiple of your annual income is what you should have. Why such a wide range? Because if insurance is supposed to be a replacement of your future incomes that you would have earned, a younger person is going to have obviously much longer duration of years of income to be earned. So for that such a customer, let's say 25 to 35 years of age, I would assume the multiple should be closer to 20. If you're older than that, start coming towards the lower end of that spectrum. So that's your first component, 10 to 20 times of your annual income. Deduct from this any employer provided coverage that you might have, because essentially what you're talking of is total insurance cover that you need. Add to this any outstanding liabilities that you might have, right? So home loan, personal loan, auto loan, child's education loan, these are things which you need to cover. Obviously, as you repay them, you can figure out a way of calibrating your cover amount.
So you just gave me the tip to the second question. My employer already gives me an insurance policy. Do I really need my own one?
Of course you do. Of course you do. I mean, come on. I'm an insurance company. I would say, why would I say no to that? Anyway, jokes apart. So guys, people switch jobs, people take sabbatical and stuff like that. So you don't want your life cover to run out, right? So it needs to be there. So employer provide coverage is good. But to have one of your own is even better.
How do I choose a good life insurance policy for myself? Pure risk, okay? We're not talking about the investment products, but pure risk.
Okay, great. Choose any company whose name starts with I. Sorry.
Okay.
But yeah, sorry, jokes apart. Guys, insurance contracts are long-term, right? So go with a reputed brand, because in the case of term insurance, right, it's your family which is going to be filing a claim and all of that. You need the trust, the solidarity, the stability of a brand. So go for reputed brands. Second, look for the size of the company. Because AUM, larger the AUM means more customers have trusted the company with, safeguarding their money. So it's obviously a good indication of trust. Third, look for the claim settlement ratio. Because claim settlement ratio is the proof of the pudding, the moment of truth, right? So look for claim settlement ratio. And apart from claim settlement ratio, look for how quickly has the company settled its claims. These are some of the metrics that you should look out for.
One of my, most important, most critical questions is, it's a very obvious one, but I still want to ask it from you, because I think claim settlement ratios are like upwards of 99%. So it's like saying that I think 95, 90, whatever the number is, life insurance claims just get passed. It's not like a health insurance where they might
exactly. And this is where I have to plug in here, but the regulator has been really pushing, ensuring that we insurers are delivering on claims.
Yeah, because you're at your most vulnerable moment where you've lost someone who's near and dear to you, and the last thing you want is for your claim to get stuck at the insurance company. Having said that, usually what are the tips or things to ensure that your claim does get passed?
Okay, great. Be honest. I mean, as an insurance company, I am sort of profiling every customer and saying, okay, great. We should or we shouldn't, or we should give a policy but charge a little higher, and so on and so forth. The last thing you want is the insurance company discovering something later on. Oh, you did not tell us this. And that becomes a little bit of a tricky one. So that's about it. Declare all the aspects.
The right way to look at this probably would be that when you're taking the policy, be upfront and honest about each and everything that you write out there. I think that it goes without. I mean, it needs saying, but without that, of course, if you mess up there, then the insurance company has something to tackle with. So okay, add-ons, riders, any points of view on that? They help.
Definitely, definitely. Well, again, it's if you go to an ice cream shop, right? You have vanilla, and then if you want to have hot chocolate and some roasted nuts on top, it depends on your choice, right? So, as an insurance company, I say, look, guys, for the plain vanilla ice cream, there is the plain vanilla product. You want some toppings like an extra, helping of critical illness cover.
You can
Well,
have that.
if you are someone who's working, who has a two-wheeler, who drives a lot on two-wheelers, you think there's a risk of accidents, you want that extra cover, well, here you go. If you feel that if it's a savings product, it comes with a default amount of life cover, you say, look, I want more life cover component, you want that. So we are keeping all the options open to customers. Of course, majority of the customers prefer the plain vanilla ice cream. You're happy with that?
And I just realized this one last thing. Should insurance covers change as we age? Obviously, the salary that I earn at 25 is not the same that I earn at 35, is not the same as I earn at 45.
Right.
But the cover that I have at 25 is good for another, say, 25 years. Although I believe that now coverage terms have also increased a lot. But what's your general view? Should someone be, reviewing this every, I don't know.
I guess I would say, again, no rule of the thumb here, but I would think about 3 years would be a good time frame, because more than the income profile changes, Anupam, actually the life stage changes happen, right? So typically, marriage, parenthood, kind of a situation, or the children's education loans related kind of thing, home purchase kind of thing. So the income change for sure is one aspect, but I guess the bigger ones are about the life stage related changes, and those do have a bearing on the kind of life insurance coverage one needs to have. So I guess a 3-year review of where you are on all those 3 aspects of income, outstanding loans, and so on and so forth, we should be about good.
Your insurance products should change as you age. I think that's quite simple. Srini, we are done. Our standard question that we ask for all of our guests who come out here: any book that you're reading or any content recommendation that you might have for our audience?
That is a super cool question, Anupam.
Thank you.
You should stick to that one a lot.
Okay.
My okay, it's not just like it's a book, but why am I making such a big deal about it? The Mahabharata. Okay, I'm like I for the longest possible time, and it's pretty much my. I've read multiple versions of that.
That also includes the Gita, by the way, which
can you believe it? Can you imagine a book of which the Gita is like just one chapter of it? Like this is beyond. And funnily enough, it's sort of almost like I've been a big fan of the Mahabharata since I was a kid, but it has actually relevance to insurance.
Of course it does. Yeah, in that way. Okay, tell me how.
I was hoping you would ask me that question. So this is awesome. One of the most fascinating chapters, personally for me at least, I find very fascinating, is something called the Yaksh Yudhishthir Samvad. Okay.
That's in the end when he goes up?
No, it doesn't. Okay. It happens midway. Oh, good. You're like familiar with the Mahabharata. That's so cool.
What
no, so the Yaksh Yudhishthir Samvad happens somewhere during the Vanvas stage, okay, right? When these guys are in exile. It's like it's a hot summer morning, and the Pandavas and Draupadi, they're like totally thirsty. And they're like, where's some water? So one of them volunteers, he goes around and he sees a pond. Okay, and he says, oh, here's a pond, let's get some water back. And just before he's about to drink water, there's a voice which says, no, you can only drink water once you answer my questions, otherwise you'll die.
Wow, okay, no, I have no idea about
this.
Oh
man, I'm going to love this one.
Go for it, yeah.
Okay, so this guy, so it's like, why should I answer a question? And he just goes, drinks water, and he dies. Okay, same thing happens, the next brother goes, here, same voice happens, he also dies. So this goes on for some time, and but it's only Yudhishthir. He's like, what just happened? And there was no Swiggy, so he had to go get the water himself, right?
Okay.
So he goes to the pond, and the same thing happens. He sees his 4 brothers lying there, and he's like, oh my God. And then he's about to drink water, and the voice says, answer my question before you drink water, or just like your brothers, you will also die. Yudhishthir was a smart guy, so he said, okay, I can see that there, so I'm not going to do it, so please ask. And then there is a series of, I think, 32 or 33 questions. Think of it like a KBC with
33 questions.
Yeah, increasing order of complexity.
I missed this chapter completely in the Mahabharata.
What are you saying? This is so, and it's like starts off with the easy ones, true false questions, fill in the blanks questions. Then it becomes a bit more deeper, and then he says, "Oh, Yudhishthir, you're so nice. You answered 32 of my 33 questions. This is the last one, and then everything will be you can live happily ever after." So he says, "Go on." So he says, what is the most amazing thing in this world?
Okay.
Okay. And then Yudhishthir thinks for a time, minute, and he says, and it actually sounds better in Hindi. He says, "संसार में सबसे आश्चर्यजनक चीज़ क्या है?"
हाँ.
Right? So Yudhishthir says, every day people see others around them die, yet they think I'm immortal.
Wow. Okay.
That's wow, right?
Wow. Yeah.
That's wow, right? I'm like, and then, so anyway, so the Yaksh is like super happy. He's like, yeah, man, you got it right. Your brothers are all back, and so on and so forth. But then when I think of it, I'm like, you know, and I keep, this was, if assuming the Mahabharata was written 3,000 years back, people say it was written around that time. For them to have thought of this, and then I think to myself that as an insurance, someone operating the insurance category, every single day, the people selling insurance actually at some point of time or the other have to ask the customer this question. You know, there's going to be, and it's not just about dying, it's also about retirement. It's also about saying, look, there's going to be a day you're not going to stop working. I'm like, no, that's not going to happen to me. Or, you know, you should buy term insurance because there could be, you'll die. So when I look back, I'm like, you know, the category of insurance is operating in a space which goes against everything which evolution makes you believe is never going to happen to you. You believe you're never going to die. You believe you're never going to age. And yet you are. And insurance as a category is trying to resolve that dilemma.
I hope that message is understood by our audience, because honestly, sometimes when I see people who are just starting their job, then they talk about which SIP to invest in, mutual fund to invest. I'm like, dude, you start with insurance here. If you don't tick those two boxes, then, you know, you've got the rest of your life to figure out the best stock or 10 bag or 100 bag or whatever. But I don't know if insurance, you know, it's like you said, you have to think about this when you are alive. I hope that you're immortal. I mean, I don't think anybody in history has been immortal. There are some attempts these days. But yeah, folks, you know, I hope that this discussion has helped you to understand your insurance needs better, and the fact that you start with insurance as one of your most basic financial product. Again, opinion, not advice these days, disclosures and disclaimers, you know, how they are. But yeah, there you go. That is it. That is the wrap on this very interesting episode of Paisa Vaisa with my guest, Srinivas Balasubramanian, Head of Products and Marketing at ICICI Prudential Life Insurance. Shrini, thank you. I mean, I think, you know, you were very frank, and I like that you took all the hairy questions also upfront. Thank you so much for sharing your insight with our listeners.
Pleasure being here, Anupam. Thank you so much for having me over.
Fantastic. Thank you.